What's your takeaway of the week so far?
Look, I think that one of the interesting things about where we are today is how crowded everyone is in equities right now. So if you look across the board, global macro funds, CTAs, risk parity, long, short, retail in particular, we're all in sort of the 90th percentile plus positioning level across the board. So when one thing sort of cascades, then the rest of the dominoes fall as well.
Do you see vol normalizing anytime soon? Because if you look at the term structure of volatility at the moment, the VIX, it's incredibly elevated at the front end. It's inverted. Sure. And it hasn't settled down through the week.
I think that depends on what you define as normal. If normal is the last 3 years, that is
well, that ain't normal.
Normal, exactly right. So I think we go back to a period similar to the sort of the immediately post-crisis period. But, back in the days of really low single digits, that's probably long gone.
Steve Pittichir of Vanda Securities wrote to me this morning, and he said the following: stocks would never have been as high either without the vol suppression that helped the PE expansion. The XIVs of this world didn't just start impacting markets on Monday. They suppressed vol throughout the whole of last year and helped the PE expansion. Do you have to reverse engineer that now and think about what that means for the market going forward from here?
I think there's some element to that. I mean, you've needed a jeweler's loop to see volatility for the last large number of quarters. And that to us spoke to an environment that was more fragile rather than not. So as this unwinds, what is normal? I mean, is it going to be 17 to 20? Is it going to be 35 to 40? You're probably going to see mid-20s as being more normal going through this. I don't think we're going to get back to 50s. Yeah. But I think as we work our way through not only these exotic notes that have created some knots in the dental floss, as it were, but then we go back to fundamentals. And I think that in the United States right now, you still got fundamentals which are largely good. The Fed is going to be more active rather than not. And we've been looking at areas where valuations were not as much of a headwind. Europe, Japan, emerging Asia, and global credit as well, as the market in the United States didn't look all that attractive.
Mike Schumacher, so far, what is healthy, I think for many people, is that it's been isolated to equities. It hasn't bled out into the bond market in a way that people might have expected. If I told them the market would be down 10%, they might say, well, you'd expect a rout in credit, some damage to the periphery in Europe. That hasn't happened. Starting to see some cracks?
Maybe just a few, not much, Jonathan. I think the concern in the bond market, frankly, in treasuries really is supply. You've got this avalanche of supply. It's been pretty clear for a while. Every time we turn around, there's talk about more issuance. For instance, the budget deal. Budget deficit gets worse, supply goes up, and that's just in the last 24 hours. So I think we're starting to see some issues there. As far as credit, investment grade, it's been rock solid, which is a bit of a mystery, frankly. You've got spreads that are still tighter on the year despite the S&P move, so that's a bit surprising. But in terms of treasuries, there's a lot of uncertainty about that.